Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to the bigger picture. Me, Ryan Huang. It's not just MAGA right now, but MEGA, Make Iran Great Again. That's what U.S. President Donald Trump is suggesting with a potential regime change. So over social media, he called for MEGA, questioning the possibility of a regime change following the U.S. military strikes against key Iran nuclear sites over the weekend. And of course, in focus now are the market reactions as well as what could play out in the coming days. And to help us out is Rodda. He is the senior financial market analyst for Capital.com. Carl, good morning. I think in your neck of the woods in London right now, it's good evening.
Yeah, well, it's good evening or good morning, depending on which way you look at it. But thank you so much for having me.
Yeah, great having you on because we've got a lot to crunch. Let's start first with your takeaways right now of how markets are reacting. Of course, very nervous start to the week.
Yeah, fairly nervous, but the moves have been relatively muted up until this point. I mean, obviously, any morning that you see a sort of potentially 2 or 3% move in oil and, a drop of, say, 1% or circa that in US futures, you start to think that, there's something significant happening in the world. But, given the significance, I suppose, that global politics, global geopolitics of the strike yesterday, the volatility that we've seen so far in financial markets has been, again, fairly contained and, perhaps suggestive of a market fairly optimistic that although there's going to be disruptions from this, that effectively two things, won't materialize in a very significant way. One, that this won't broaden out into something more regional that will embroil the United States and a much more significant conflict, and that global energy markets, while, higher risk of being disrupted because of perhaps certain assets being targeted or of course, the key thing is that the Strait of Hormuz might be, more or less cut off. The odds of that, probabilities of that are still considered relatively low, and that's why the moves have been fairly contained. So there's two ways to cut that. Again, the market's taking an optimistic view that this won't be as disruptive to markets as it will be to sort of obviously the politics of the region. But the flip side of that is that, there's more room for shock if one or two of those things, or perhaps even both, starts to materialize.
Yeah, Carl, do you get a sense that perhaps markets might be a bit too complacent right now with the potential for this to drag on? And of course, like you pointed out, the Strait of Hormuz could be affected, and it's a very key part of the oil supply route, which could then mean higher oil prices, which could then mean a lot of things for the rest of the economy.
Well, absolutely. I mean, I think, obviously it's not my job to necessarily estimate these things, but, those who I follow who do suggest that if we do see a total blockade of the Strait of Hormuz or even, significant enough disruption to sort of tanker flow because of, obviously hostilities in the region, that could take, maybe hundreds of thousands of barrels of oil off the market per day, which, would be a fairly material supply shock that would have to get priced into the market and would be more, I dare say, than just the 2% rally that we've seen in oil prices to the mid-70 handle or thereabouts to say West Texas Intermediate. So I don't think the markets are really pricing that in. So absolutely, it's like I said before, that if this is the move that we're seeing, it certainly reflects a higher risk premium, based on the fact that there's this uncertainty now coming out of the Middle East. It would also appear that it's a market that is betting that this conflict will remain relatively contained, so much so that it won't be have a material impact on energy markets, or that as well significantly as a knock-on effect of that to global growth or inflation expectations.
Okay, so let's play out these potential scenarios. If we do get restrictions in the Strait of Hormuz, what could we expect in terms of the beneficiaries, in terms of the markets when you look at perhaps oil and gas stocks or energy and other sectors?
Yeah, well, obviously it becomes kind of an energy and everything else dichotomy. So, you get the energy stocks climbing, oil prices climbing, natural gas prices, which have already, perked up again over the last few weeks, not just, of course, due to the situation in the Middle East, really being the key plays to directly trade these sorts of events. The other side of that too is, of course, if we do see that kind of escalation, broadly speaking, I think you will see sort of equities coming off quite materially. You'll see a sort of run up in the yield curve, yields higher across the board, but certainly a run up in the yield curve as we've seen recently. These higher inflation expectations will have to be priced in, but you'll probably also see a simultaneous rally in the US dollar and gold prices to the US dollar, because the US economy remains a sort of next exporter of energy, as well as there's going to be a demand for liquidity, and gold as well, which might be another one to point to as a signal today, being a little bit lower, I think, off or at least certainly off the highs of the day, as being one that'll have to sort of price in that geopolitical risk. But realistically, a little bit like what happened at the start of the Russian invasion of Ukraine, or even the October 7 attacks and the subsequent events that we saw around there, is that it'll be sort of an energy and everything else trade as far as bullishness goes, and then you'll see basically that risk aversion creeping in sort of into market price action.
Okay, so that's where the money could be flowing. How about on the other side of the equation? How about airlines? We've heard from British Airways and Singapore Airlines cancelling their routes to Dubai. Of course, they are also sensitive to oil prices. How much could they be impacted?
Oh, enormously so. I mean, as you mentioned off the start, I'm in London at the moment. I will be flying through, Qatar at some point, or hopefully in the next sort of month or so, and keeping a very close eye, of course, on what sort of disruptions potentially there could be. Not only for the fact that in the best case scenario, we're seeing a significant rerouting of flight paths to avoid obviously the airspace effectively over Iraq between Israel and Iran, and on top of that, these sort of higher energy prices, which clearly airlines are very sensitive to, their margins are very sensitive to. So you're seeing a cost impact just from the disruptions alone. If it manifests obviously in a broader conflict, which obviously airlines start to run safety concerns for running flights, whereas running as many flights as they would normally under typical conditions, then that's a significant disruption for them, and something that would certainly hit their share prices. So I have to say, something that I'm watching from a personal point of view, just so I can get home eventually, which I'm confident that I will be, of course, but also the investment impact because of the sort of high sensitivity, the high beta that airlines have in this situation.
Yeah, for sure. Hope things work out for you. Talking about investment impact, we've got earnings out this week from the likes of FedEx as well as Nike. Now, with what's playing out here, higher oil prices potentially and all the uncertainty, what do you expect in terms of how this could play out to add more inflationary pressures or even slow down the economic outlook?
Yeah, it'll be, I guess a two-part answer, the macro and the micro here for some of these companies as well. But, if we do see a significant shock to the market here, it's another price shock, it's another supply shock, and that's another stagflationary influence as well on top of US trade policy for the markets. And I guess that probably dovetails into the most important theme for both of these companies' earnings, for separate reasons, but equally the same in their own right, is trade policy in the United States and how that's affecting the US consumer, or has done. Retail sales last week was fairly weak in the United States, and starting to show signs that maybe consumption patterns are kind of reflecting a lack of confidence about the future because of trade policy. And there's also obviously the concerns of lower global trade, higher costs for business as well, which may manifest in FedEx's earnings too. I suspect once more, that there will be a sort of a level of concern about the stagflationary impact of potential conflicts in the Middle East and broadening out of the conflicts in the Middle East. But below this, for the markets, the biggest concern remains, obviously trade policy, which, it's wild to say, but escalation in the conflict in the Middle East has sort of taken that off the front pages for the markets. But it will be very meaningful. We can really argue that we're living in the age of supply shocks, and businesses' performance is going to be most impacted by these, how they navigate these supply shocks. For earnings to this quarter, for companies like FedEx and Nike, it's going to be about how they deal with the trade supply shock. Now, maybe even on top of that, the supply shock coming from the Middle East too.
Yeah, more uncertainties for businesses as well as consumers to watch out for, especially with the earnings underway. And we've been in conversation with Carl Rodda. He is the Senior Financial Market Analyst at Capital.com. Carl, thanks so much for your help this morning, and good luck on your way home.
Thank you so much, Ryan. Have a good one.
All right, catch up with you again soon.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.